GST Business Model, Masters of Commerce, 4th semester, Mangalore University, Session 7. GST Procedure, Center State Financial Relationship under GST, State Government's Financial Problems after GST Era. Learning Objective, to know about the center state financial problems after the implementation of GST. Session Objective, to discover the reasons for the financial problems under GST. Center state financial relationship after the implementation of GST. Fiscal powers between the state and center are clearly demarcated in the Constitution. The center has the powers to levy tax on the manufacture of goods except alcoholic liquor for human consumption, opium, narcotics, etc. States have the power to levy tax on sale of goods. In the case of interstate sales, the center has the power to levy tax, the CST, but the tax is collected and retained entirely by the originating states. Since the states are not empowered to levy tax on the sale or purchase of goods in the course of the importation into or exportation from India, the center levies and collects this tax as additional duty of customs, which is in addition to the basic custom duty. This additional duty of customs counterbalances excise duties, sales tax, sales VAT, state VAT, and other taxes levied on the like domestic product. Introduction of the GST would require amendments in the Constitution so as to concurrently empower the center and the states to levy and collect the GST. Concurrent jurisdiction to the center and the states for the levy of GST would require an institutional mechanism that would ensure that decisions about the structure, design, and operation of GST are taken jointly by the two. GST will affect mainly the fiscal relations between the center and state. Till date, the center and the state were independent on the tax collections. There was a clear demarcation between the state and the central taxes in the Indian tax system. With the implementation of GST, the taxes now need to be shared by both the governments. It is to be clear that the implementation of GST is not giving any fiscal relief to the taxpayer. Instead, we end up paying a bit more than what we used to pay earlier. Under GST, the center and the state has to agree upon a fixed tax rate, which till today were independent of each other. The main advantage of GST will be that it would create a unified national market. It is, of course, absurd to state that India does not have a unified national market at present, and implementation of GST will be one of the first steps towards creation of unified market. With the implementation of GST, the richer states are going to lose much of revenues. This is because GST will be collected at the point of sale and not at the point of manufacturing. That means if a manufacturing unit in Maharashtra is selling its product in Orissa, then the government of Orissa can collect the tax and not the state of Maharashtra. This means the states who are not financially strong will get an opportunity to gain revenue. To compensate this, the central government has decided to compensate the state governments with the losses they may incur post implementation of GST for the first 5 years. State government's financial problem after GST era. GST is a destination based taxation system. IGST revenue on interstate sales, SGST portion, will accrue to the state which consumes the goods, that is the destination based tax, DBT. Whereas in the existing scenario, when CST was charged at 2%, when C form was produced, or local VAT rate if same form was not produced was charged, it would accrue to the state which supplies the goods. Hence, CST is origin based taxation as it accrues to the state which supplies it. In the current scenario, manufacturing states is going to lose its portion of revenue from the interstate sales and the consuming states are going to earn higher. Thus, the state governments fear loss of revenue and expects compensation from the center. Manufacturing states like Tamil Nadu, Gujarat, etc. loses and the consuming states will gain due to this change. States with high and strong manufacturing base will be biggest contenders for compensation. Tamil Nadu government may lose around rupees 3,500 crore annually due to the abolition of CST and want compensation from the center. Maharashtra government may lose rupees 14,000 crore that it collects as octroi. Loss of federal autonomy. According to the Constitution of the 122 Amendment Bill 2014 passed in the Lok Sabha, India will have not a single federal GST but a dual GST levied and managed by different administrations. The center will administer the central GST and the states the SGST. The monitoring of compliance will also be done independently at the two levels. Moving to a GST regime in federal setup will mark some curtailment of states' freedom. All goods and services will be divided into certain categories. The rates will be fixed by category and a state cannot shift a commodity from a lower to a higher rate or put it in the exempt category. GST will mark the erosion in the state's freedom to decide on taxes and tax rates. According to the Constitution, the states have complete autonomy over levy of sales taxes, which on average accounted for 80% of their revenue. But with the GST, which mandates a uniform rate, even this limited autonomy would be gone. Uncertainty clouds over major incentives offered by the state government. Tax incentives are granted by the state governments to companies making investments in the respective states. Some tax benefits are generally granted by states as subsidies based on the quantum of taxes paid, that is, VAT and CST, by the companies to the state government on their manufacturing activities, and that too over a specified period of time. Of course, such incentives are subject to a maximum ceiling limit based on total capital investments made by these companies. Since the amount of incentives are based on the amount of indirect taxes paid to the state government, it is important to analyze how these incentives would get impacted under the GST scenario. Let's take an example. A unit in Maharashtra is promised that 100% gross VAT or CST paid by it will be refunded by the state government as a subsidy for a period of 15 years. Of course, the subject to the cap of total investment made. On its sale of say around rupees 1000 crore per year, it gets an incentive of 41 crore, which is the tax paid by the unit on its 20% local sales and 80% interstate sales. Since CST is also paid by the government of Maharashtra, being the originating state, that too is calculated towards the incentives. In GST, however, there would a twofold impact on the quantum of incentives. One, interstate sales would not contribute to the incentives under GST, and next, second one, the effective tax rate could also be lower. With respect to the tax on interstate sales, Since the tax would accrue to the destination state, the government of Maharashtra is not likely to give any benefit. The benefits are thus limited to the 20% local sales, which will bear, say, 9% on its GST, assuming a GST rate of 80% that is divided equally between the center and the state. Today, local sales attract a VAT of 12.5%. As a combined impact, the hypothetical unit would get an incentive to the extent of Indian rupees 18 crore per year, which is less than half of 41,000 crore, 41 crore it received in the pre-GST period. Shift in the power. Earlier, the center alone can tax services. In GST, it is proposed to delete any entry from list 1 so that the states as well as the center can tax services. Also, both center and states are to be explicitly empowered to levy goods and services tax, which is defined as a tax on the supply of goods or services or both. Thus, the Constitution, upon the amendment, will support levy of tax on services as well as goods by the states as well as the center. States to retain the power to levy tax on certain goods. States have insistently demanded certain goods to be kept outside the ambit of goods and services tax. Taxes on alcohol make up major chunks of state revenues. For instance, in Kerala, it contributes 22% of revenue, while in Tamil Nadu, it yields about 21,000 crores per year. Transport fuels like petrol and diesel are taxed at 20%, while states earn 35% of the sales tax revenues from them. Initially, most of the states were not in favor of keeping many commodities under GST. The main reason was that states enjoy autonomy in collecting state taxes and they were afraid of losing their rights. State governments wanted the alcohol and fuel to be kept out of GST system as these two commodities are the biggest contributor to their revenues. State governments 50% revenues come from the petroleum products alone.